Peter Lynch.
Yeah.
I mean, the name alone is legendary in the investment world.
Oh, absolutely. From 77 to 90, leading Fidelity Magellan.
And delivering, what was it, a 29.2% average annual return. Just incredible.
Yeah, more than doubling the S&P 500 over that stretch. In his book, One Up on Wall Street.
Right. Came out in '89, sold over 1 million copies. But it wasn't just a bestseller, was it?
No, it felt more like a clarion call, really. A powerful argument that, the average person could actually beat the pros.
Which is the big question for us today, isn't it? In this world, the one we live in now, with algorithms, instant data, does that core idea still hold up?
Or is it maybe a brilliant idea whose time has passed?
Exactly. So in this deep dive, we're going to perform an autopsy, so to speak, on One Up on Wall Street, using the sources we have, really get to the heart of it.
And ask that critical question. Can you, the listener, the average investor, still compete? Can you really outperform Wall Street today?
That's our mission. And Lynch seemed to think the answer was yes, but it wasn't just tactics. It was about a mindset.
Yeah, what you're calling the grounded investigator mindset. We need to unpack that.
Okay, so what was so compelling about the book, beyond the track record?
Well, I think it was the psychological shift he was aiming for. He wanted to, demystify Wall Street, empower the individual.
Which must have felt pretty radical back in the late 80s.
Totally. Finance was getting more complex. Fund managers were like gurus. And he comes along and says, hey, you have advantages they don't.
Telling people their everyday life, their observations, actually mattered.
That reframing was key. It really resonated.
Okay, so he was optimistic about the individual.
Yeah.
But what did he see as the big problems, the sins almost, holding people back?
Well, he definitely pointed out a few big ones. Top of the list maybe was the tyranny of experts and institutional groupthink.
Right. What did he mean by that exactly?
He argued that fund managers, even with all their resources, were often, constrained, boxed in.
How so?
Well, pressure for short-term results, needing to look good now, led them into kind of herd behavior.
Everyone chasing the same popular stocks.
Pretty much. And they often couldn't really invest in smaller, less-known companies. They weren't on the radar, maybe too small to make a difference in a huge fund.
And admitting you were looking at some tiny company, maybe not great for your career.
Exactly. Humility is tough in those settings. It's hard to say, I'm still figuring this little thing out.
Yeah, I could see that. What was the second issue he tackled?
He was really skeptical of over-reliance on macroeconomic forecasting and market timing.
Trying to predict where the whole economy or market is going next week, next month.
Right. He basically called it a futile endeavor. Wasted energy. He famously said he didn't try to time the market or predict the economy.
Which is pretty amazing for a guy running Magellan.
It is. Now, that doesn't mean ignore everything about the economy.
But don't bet the farm on forecasts.
Precisely. Focus on the business you're investing in, its durability, its prospects through the cycle. Don't try to dance in and out based on guessing the future.
Okay, that makes sense. What else?
Third, and this is a big one, emotional decision-making and short-term speculation.
Fear and greed. The classics.
Yep. People panicking and selling low in downturns or chasing fads when things get hot. Investing becomes more like gambling.
Less about earning a business, more about betting on stock tickers.
Exactly. And finally, he really wanted to tackle the perception of information asymmetry.
The feeling that Wall Street has all the secret info.
Lynch wanted to show individuals that their own knowledge, their unique observations from their job or life, that was a distinct asset. Information Wall Street didn't have easy access to.
A different kind of edge.
A different angle, yeah. Leveraging stuff you see that isn't on the Bloomberg terminal.
Okay, so he points out these flaws. And his solution, his big idea, was that the average person could win by using that unique knowledge, doing the homework, focusing on stuff they understand, and thinking long term.
That's the core thesis, developing your own investor's edge.
But for this whole system to work, there must be some underlying beliefs, some assumptions.
Definitely. There are foundational beliefs baked into it.
Okay, let's get into those. What has to be true for One Up on Wall Street to actually function?
Well, the first big one is what we could call the observational financial link.
Meaning, what you see in the real world connects to the stock price.
Basically, yes. The belief that observable stuff like a product suddenly being everywhere, or a store always being packed, or seeing a company expand locally often correlates with financial health and eventually stock performance.
So your everyday life can be like a a leading indicator.
Potentially, yes. A signal that something interesting is happening, something worth digging into.
But and this is crucial, right? It's not just about liking the product.
Absolutely not. That's where people often get tripped up. Lynch was crystal clear. Liking the donut shop is a great reason to get interested and start researching. It is not enough reason to buy the stock.
You need more than just the observation.
Right. The whole idea rests on the assumption that there's some market inefficiency, that these observable qualitative things aren't instantly priced in, giving the individual who notices and then does the work a potential edge.
Okay, observation triggers investigation.
Yeah.
Got it. What's the second assumption?
The second one is a belief in the diligent individual's capacity.
Meaning the average person can actually do the necessary homework.
Yeah. Lynch believed that an average person, if they're smart and committed, can access, understand, and analyze company information, financials, business models, competition well enough to make good, independent decisions.
He had that famous line about using 3% of the brain, right?
Chuckles, yeah. Bit of hyperbole, perhaps.
Maybe just a little bit optimistic for reading a 10K.
I think his own work ethic shows it takes more than 3%, but the underlying belief is that the information is out there. It is understandable if you put in the effort.
So it assumes transparency, discoverability.
And crucially, a willingness to commit significant personal time and intellectual energy. This is not a passive approach. It works if you do the work.
Okay, so sharp eyes, believe your observations matter, trust you can understand the details, and then roll up your sleeves. That's the attitude. How did he translate that into a process, a system?
Right. This is where we get practical. I think it rests on 3 core pillars, all feeding into that grounded investigator mindset.
Okay, pillar 1.
The absolute foundation. Your world is your research lab.
This is the famous invest in what you know. Let's unpack that carefully.
It's not just about liking things. It's about leveraging your existing, sometimes very specialized knowledge.
From your job, maybe. Or a serious hobby.
Exactly. If you're a doctor, you have insights into medical devices. A teacher sees trends in educational tech. A gamer understands the gaming world deeply. That specific knowledge you already have, that's your unique starting point.
Your personal scouting ground.
Yeah, that's a good way to put it. Your daily life is like an early alert system. You might spot trends or companies that big institutions overlook because they're too small or niche.
So it's using a different kind of information edge again.
Precisely. Not secret Wall Street info, but qualitative real-world knowledge that maybe isn't widely appreciated yet. Like his idea of a local edge for finding asset plays, knowing about valuable local real estate a company owns.
And in today's world, with just information everywhere, this helps you focus.
Absolutely. It's an efficient way to narrow the field. Focus your energy where you already have some understanding, some advantage.
Okay, so your radar pings. You see something interesting in your world. Pillar 1 done. What's next? How do you structure the investigation?
That brings us to pillar 2, the rules of engagement and the lexicon. From observation to investigation. This is where the analysis gets structured.
Starting with the story and his company categories.
Right. Lynch insisted you develop a clear story for every stock. Basically, your investment thesis. Why this company? What needs to happen for it to succeed? What would make you sell?
And the categories help build that story. Slow growers, stalwarts.
Fast growers, cyclicals, turnarounds, asset plays.
Yes.
Those 6 categories are fundamental.
Why? Why not just analyze every company the same?
Because you'd miss vital signs. A low PE ratio is great for some stocks, but it can be a huge warning sign for a cyclical near its peak.
Okay. So the categories are like diagnostic tools.
Exactly. They guide you. They tell you what metrics matter most for that kind of company. What does healthy look like for a stalwart versus a fast grower?
So you look for different things. Dividends for slow growers.
Versus growth rates and balance sheets for fast growers. It prevents you from, misapplying metrics across the board.
And it helps mentally too, psychologically.
Big time. If you understand the type of company and its story, you're less likely to panic during normal volatility. You know a cyclical will have ups and downs. You hold a fast grower through dips if the growth story is intact. It anchors you.
Makes sense. Can we quickly recap those categories?
Sure. Slow growers. Mature, low growth. Focus on safe dividends for income. Risk is stagnation.
Okay.
Stalwarts. Big known companies, maybe 10, 12% growth. Look for decent PE, stability, Good for 30-50% gains maybe. Risk is they slow down.
Got it.
Fast growers. Smaller, aggressive, 20% plus growth. These are the potential 10 baggers. Lynch loved these. Focus on growth rate versus price. Peghead.
Scary.
Strong balance sheet. Room to run. High risk, high reward.
10 baggers.
They do the dream.
Cyclicals. Business follows the economy, like autos, airlines, steel. Timing is critical. Buy low, sell high in the cycle. Big risk if you miss time. Low PE can be a trap at the peak.
Tricky.
Turnarounds. Companies recovering from major trouble. Look for proof of fixes debt down, costs cut, profits returning. Very risky, could fail completely, but huge rewards if they succeed.
High stakes. And asset plays. Company value is really in hidden assets. Real estate, cash, patents. Need to spot that hidden value. Often requires patience for it to be unlocked.
Okay, that framework is super helpful. What's the next tool within Pillar 2? You mentioned 10 baggers.
Right, Model 2. The 10-bagger hunt and the PEG ratio. Lynch popularized 10-bagger, a stock that goes up 10 times. That captures the ambition, especially with fast growers.
But he wasn't just chasing growth blindly.
No, absolutely not. He wanted growth at a reasonable price jar up. That's where the PEG ratio is crucial.
Price to earnings divided by the growth rate. He liked it below 1.
Ideally, yes. PE divided by earnings growth rate. A PEG of 1 means the PE ratio equals the growth rate. Below 1 suggests it might be cheap relative to its growth.
Why is that better than just PE?
Because context matters. A PE of 30 sounds high, but if growth is 40%, the PEG is 0.75 may be attractive. A PE of 10 sounds cheap, but if growth is only 5%, the PEG is too maybe expensive. It links price to growth.
So the 10-bagger hunt is the dream, PEG is the reality check.
Well put. Ambition tempered by discipline. And aiming for 10 baggers also reminds you about patience letting winners run, not pulling the flowers to water the weeds.
Yeah. Painful image because it's so true. Okay, idea spotted, story framed, category chosen, price checked with PEG. What's the non-negotiable final step?
Model 3. Diligent homework, the scuttlebutt, and financial deep dive. Lynch hammered this home. Always do your homework. This is where you validate everything.
Scuttlebutt. Love that word. What is it again?
It's basically qualitative field research, talking to customers, suppliers, competitors, visiting stores, trying the product, getting a real feel for the business on the ground, borrowed from Phil Fisher.
And on the hard numbers.
Absolutely. A deep dive into the financials. Balance sheet strength, how much debt, debt to equity ratio, consistent earnings, cash flow, and knowing which numbers matter most for that specific company category.
So it's not just, is the product popular?
No, is that popular product a meaningful percentage of sales? What's their debt look like? Are customers happy? It connects the observation to the business reality.
You're blending the qualitative, the scuttlebutt, with the quantitative financials.
Exactly. It gives you a much more robust, like three-dimensional view. Scuttlebutt provides context, early warnings maybe. Financials ground the story. It's the art and the science together.
Okay, Pillar 1, observe. Pillar 2, investigate systematically. What holds it all together when the market inevitably goes crazy? Pillar 3.
Pillar 3 is the psychological armor. The stomach, not the brain. This is huge for Lynch.
Because great analysis doesn't matter if you panic sell.
Precisely. He famously said, the stomach is a more important organ than the brain for stock market success. Temperament trumps intellect when things get scary.
So how do you build that fortitude? What was his advice?
He offered several principles. 1. Embrace a long-term perspective. Think 10, 20 years, not 2-3 months. Stocks are way more predictable over the long haul.
Counteract short-termism.
2. Ignore market noise and forecasts. Tune out the daily drama, the predictions. He argued more money is lost preparing for corrections than in them.
Trying to dodge the dips often means missing the rebound.
Exactly. 3. Avoid market timing. He saw it as pointless. His research showed even if you invested at the market peak every year, you'd still do fine long-term if you just stayed invested in good companies.
Wow. So just staying in is key.
4. Cultivate emotional discipline. His mirror test. Look yourself in the eye. Can you handle a big drop without freaking out? Know your own tolerance before you buy.
Be honest with yourself.
And finally, maintain focus on company fundamentals. Remember, behind every stock is a company. Find out what it's doing. If the business story hasn't soured, a price drop might actually be a buying opportunity.
So the deep research from Pillar 2 fuels the conviction you need for Pillar 3.
That's the connection. Investing is an endurance race. Your stomach, your temperament determines if you finish. The psychological tools stop you from making unforced errors, selling low, buying high impulsively.
The pillars really do work together. Analysis builds conviction, conviction builds resilience.
Exactly. It's a system.
Okay, we've dissected the system. Now for the big stress test. How does this hold up today? Can you still use invest in what you know effectively now?
Right. Does it work in the 21st century? Let's start with what still seems potent. The core idea of observing trends in your world. Still powerful.
But maybe not at the mall anymore.
Maybe not just at the mall. Think about spotting a niche direct-to-consumer brand blowing up online. Or noticing a specific B2B software tool suddenly becoming indispensable in your industry.
Like a digital marketer seeing a new platform take off, or a nurse seeing a better medical device.
Precisely. That professional edge is still very relevant. And consumer observation still matters. Seeing brands with cult followings online, products solving real pain points, services that genuinely impress, then digging into why.
Okay, what about applying it to complex tech? That feels harder than understanding, say, Dunkin' Donuts.
It is harder, no question. You might need real technical expertise to have an edge in, say, advanced biotech or AI infrastructure, but it's not impossible.
Like someone deep in cybersecurity understanding Fortinet's niche.
Exactly. If they combine that specialized knowledge with Lynch's financial checks, the homework is still essential. So the principle adapts, the examples evolve. Maybe it's less about physical retail, more about digital trends, B2B supply chains.
And the sharper approach? Growth at a reasonable price still applies.
I think so. And crucially, that qualitative edge, the scuttlebutt, the insights from what you know might be even more valuable today in some ways.
How so? In an age of big data.
Because algorithms are great at crunching known data. But human observation of subtle shifts, grassroots trends, product quality issues that can sometimes precede the data algorithms see, that qualitative insight, combined with financials, is hard to automate.
Interesting. So that's the bull case for Lynch today. What about the challenges? Where does the model bend or break?
Okay, several big ones. First, the invest in what you know oversimplification and complexity barrier. This is probably the most dangerous part if taken superficially.
Just liking the iPhone isn't enough.
Not even close. Understanding Apple's global supply chain, its competitive landscape, its service revenue model, that's a massive undertaking. The barrier to truly knowing is incredibly high for many complex modern businesses, much harder than understanding a simple retailer.
So the average person might just not be able to do sufficient homework in some areas.
That's a real risk. Second, diminished informational edge and market efficiency. Information moves so much faster now. Reg FD, the internet, data services, news hits everyone instantly.
And algorithms trade on it in milliseconds.
Exactly. So that window where your local knowledge gives you an edge before the market catches up, it might be much, much narrower now. The information gap has definitely shrunk.
Okay, what about the paradox of Lynch's own trading style? High turnover versus long-term advice.
Yeah, that's a tough one. Magellan's turnover was often huge, 300% or more. That means holding periods of months, not years. It seems to contradict his advice to individuals.
So, do as I say, not as I did.
Possibly. Or maybe his professional strategy involved actively exploiting short-term mispricings in a massive portfolio, something individuals can't easily do. His advice for individuals might be the safer, more achievable path given their constraints. He also wasn't purely a growth guy. He moved across categories opportunistically.
And finding those 10-baggers, is that just harder now?
It was always hard. But yes, in arguably more efficient markets, especially in easily understood sectors, maybe they are rarer, or the chance to buy them cheap is fleeting. And knowing when to sell a big winner is just as hard.
Plus, the world is global now. Lynch was very U.S.-focused.
Big point. Global investing adds layers of complexity. Different accounting, regulations, political risks, makes what you know and homework much harder.
So the main challenge today boils down to speed.
I think largely yes, the velocity and ubiquity of information processing. It compresses the time advantage an individual observer might have once had.
Okay, we've done the autopsy, we've seen the strengths, the weaknesses today. How does it all synthesize? What's the one big takeaway?
Well, putting the pillars together, it's a system for thinking like an observant, analytical business owner, not just a stock picker. It's captured in his phrase, behind every stock is a company, find out what it's doing.
It's really a whole mindset.
It is, a process. Start with curiosity. Identify businesses. Investigate with discipline. Story, category, growth price, financials, scuttlebutt. Develop the psychological strength to act and hold money. And keep reevaluating. It's iterative. You learn from mistakes.
So if you could only keep one thing from one up on Wall Street today, what would it be? The single most valuable tool?
For me, based on this whole deep dive, it has to be cultivating the grounded investigator mindset.
The grounded investigator. Break that down for us.
It's really two things fused together. Being grounded. That means keen, insightful, real-world observation. Noticing things about businesses you can genuinely understand, often through your own experience, having that radar switched on.
Okay, grounded in reality.
Yeah.
And investigator.
That's the diligent, independent, skeptical analysis. Doing the actual work, the deep, fundamental homework. And crucially, trusting your research over the noise, over the herd, over the gurus.
Why is that combination so powerful? Maybe especially now.
Because it forces you to be active, not passive. It connects the tangible world to the stock price. It moves you from just following tips to actively seeking situations where the market might be misunderstanding a business based on evidence you've gathered.
Finding value or growth others miss.
Exactly. It's your defense against hype, your guide through complexity. It builds real conviction because you did the work. It's fundamentally about understanding how businesses actually create or destroy value.
And it sounds inherently contrarian.
It often is, yes. Contrarian and evidence-based. You're looking for gaps between perception and reality, but your stance is based on your observation and research, not just gut feeling, ignoring the herd because you've done the homework.
And it keeps you humble.
It has to. Fosters intellectual humility. Always seeking more info, questioning your own assumptions, adapting when the facts change, knowing the case can evolve. Learning is continuous.
So, one up on Wall Street. It's really offering a durable philosophy, isn't it? More than just tactics.
I think so. And that grounded investigator mindset. Maybe that's the enduring alpha, the most valuable thing Lynch left us.
So the question for you, the listener, is how can you apply that mindset in your world with your research?
Because maybe cultivating that grounded investigator within yourself, perhaps that's the most valuable investment you can possibly make right now. Not just for your portfolio, but for how you think about the world.